All right, objections around maximum cash value policies. We are going to hit on our first objection, meaning I want a policy for maximum cash value, but I hear that I might run into a modified endowment contract if I set up a policy for maximum cash value. Let's address this objection in detail. So, what is a MEC? A MEC stands for Modified Endowment Contract. Any life insurance policy can become a MEC or modified endowment contract. So a core benefit to cash value life insurance is if I set up everything properly, the cash value is a safe, liquid, and tax-free area to position money. Now, I said if I set up everything properly. It is always safe, it's liquid if it's not a MEC, and it's tax-free if it's not a MEC. If a policy becomes a MEC, a modified endowment contract, specifically what happens is I have to deal with taxation. The cash value still grows tax deferred, but anything I access in respect to the gains, I have to deal with ordinary income tax. And if I'm under the age of 59 and a half, I have to deal with a 10% penalty tax as well. In short, I do not want a policy to become a modified endowment contract. It ruins everything. Now, with that said, every policy has what is called a MEC limit. And we've got other content and videos that go into detail on this, so I'm not going to go into all of the details here. But another name for that MEC limit or that MEC test is our 7-pay test or 7-pay premium. So what that is, or I should say the MEC limit, it's exactly what it sounds like. It is a limit that is really enforced by the IRS that determines how much money I can pay into a policy per year and still have the IRS view my policy as life insurance, and then I get the tax favorable treatment on my cash value and not this MEC. If I go over that MEC limit in terms of how much I pay into the policy, that's when I can trigger a MEC. Now here's the beautiful part. When it comes to a life insurance policy, we can set that MEC limit almost wherever we want. For example, if I want to be able to pay in $50,000 per year into a policy, I can set that MEC limit at $50,000 or more. I have control of doing that as the agent and the consumer when I set up a policy. So often we'll ask an individual, how much do you want the ability to pay into a policy on any given year? And if one says, hey, best case scenario, I want to be able to pay up to $100,000 per year, then we set that MEC limit at, guess what? $100,000. Sometimes more if they want to be able to pay into a policy for a long period of time. Now, why do we have the number 7 there? So that 7-pay premium test, really what this represents is the first 7 years of a life insurance policy. What I like to reference really is the IRS looks at the first 7 years and their vice grips are tight on life insurance policies during that period of time. So if I have a $50,000 MEC limit, let's use that same limit here. I've got a $50,000 MEC limit. That is the maximum amount of money I can pay into the policy per year during the first 7 years of that life insurance policy. If I pay in greater than $50,000, I will trigger a MEC. Now the nice thing is, if I ever trigger a MEC, the insurance company notifies us right away, and it's very easy to reverse. But if my MEC limit's $50K, that 7-pay test, the first 7 years, I can pay up to $50,000 per year into the policy. Now it is a cumulative number, meaning unused MEC space does roll over year to year. To demonstrate, if in the first year, year 1, I paid in $50,000, but year 2, I only paid in $25,000. What that means, year 2, I could have paid in an additional $25K, but I did not. That will roll over to the next year. So again, I could have paid it in, but I didn't. The next year, year 3, my policy MEC limit resets at $50K. That rolls over, so it's technically $50K plus $25K, so I can make a total payment of $75,000. That is per the IRS limitations, my actual MEC limit. I do need to ensure that my insurance policy and the insurance company I'm working with permits catch-up payments as well. Some companies do, some companies don't. So cumulative, meaning any unused MEC space, will roll over year to year. Now, the objections we hear around this, and by the way, I didn't explain this, FUD tactics. This came from a good friend of mine who always gives excellent advice to our videos. FUD stands for fear, uncertainty, and doubt. Meaning we see a great option, in this case, a great high cash value life insurance policy, and then are told, oh, don't do that. Really fear, uncertainty, and doubt, meaning objections raised without any clear evidence or real data to support that objection. So the objection we hear often is beyond the 7th year is a policy will trigger a MEC if I go with a, call it 1090 split, or maximum cash value policy. So, is that possible? The answer is yes. The answer is also yes with almost any type of split. Meaning if I design a policy and I have money going toward cash value, that PUA rider, I can run into a MEC beyond the 7th year. What happens is once I surpass the first 7 years, once I hit year 8, that MEC limit resets, and as time passes, it adjusts. The MEC limit has a direct relationship still to my age and death benefit, but also what my total cash value is. How the cash value and death benefit move together will determine if the policy will become a modified endowment contract or not. Now, if I'm told, hey, if I go with the policy that looks the best, has the most cash value, guaranteed and non-guaranteed, but it will MEC beyond year 7, well, that means I wouldn't want to go with that policy. So if the policy does MEC beyond year 7, I would specifically want to know how and why. Here's what I want to touch on. We've got this up here, original illustration and then actual policy. So several years ago, this is a true story here, and it's very important to be aware of this. Several years ago, I had spoke with an individual. He had purchased a policy through a smaller life insurance carrier, and the policy was designed with a 40-60 split, something like that. It was 30-70 or 40-60. What that means is if he's paying in $10,000, $4,000 went toward the premium, everything else went toward the PUA component. When he bought the policy, he was told it will not MEC. The illustration stated, you will not run into a MEC. He's been paying into it for about 8 to 9 years. He receives an in-force illustration. It states if you continue to pay in the same exact amount of money that you've been doing since day one, since you opened that policy, you will run into a MEC in policy year 18. So he's upset. This was not a policy we put in force. He brought it to us. He's upset. He said, hey, I did everything I was supposed to do from day one, and now I'm told I'll run into a MEC in year 18. Like, what's going on here? Why is there a difference? What's happening? Because again, the original illustration stated I would not MEC, but then the actual policy does MEC. This happens very, very often in the insurance industry, and a lot of times it throws agents off as well. It's like, hey, that's not supposed to happen. And in an agent's defense, they are never told that would happen either. The training is very, very weak in the industry. So why that happens is when that policy was purchased, that original illustration was based off of a dividend rate, let's call it of approximately 8.5%. However, 9 years later, the dividend rate has come down. Now it's about 6.5%. So the dividend rate's come down, which means he has less cash value than what he originally thought he would have, which is one thing, but the dividends come down. Here's the thing. The dividend came down, which means the death benefit appreciated, it increased at a slower pace than that original illustration displayed. So, going back to this, beyond the 7th year, can a policy MEC? Yes. What does it have a direct relationship to, that MEC limit? My age and death benefit. In a higher dividend rate assumption, that death benefit will grow over time. If dividends come down, the death benefit did not grow at the original anticipated pace. Now he's going to run into a MEC. He A, needs to reduce his payments, or B, stop altogether prior to year 18. Now, I realize that can be a little confusing, and I realize I go through this stuff fast sometimes. So, we're going to look at some examples here. Here's what I want to touch on first, is if we hear that a policy will trigger a MEC, meaning if I go with a minimum premium policy, you can't do it because it'll MEC long term. You know it won't. The policy I mentioned earlier was not a 10/90 split. I was closer to a 40/60. Here's the solutions in order to really assure we don't trigger a MEC with any type of design. Number one, design it with an increasing death benefit. Or number two, overinflate the death benefit and MEC limit from day one. So what I mean when I say that is if I'm paying in $50,000 per year, I can design a policy with, call it, an $80,000 MEC limit. I can do that through a term rider. I'm overinflating it from the get-go. The benefit there is, again, going back to the fact that it is a cumulative limit. Remember, I've got that rollover space, so I can bank on that over the long haul. Now, here's how I really test a policy, which we don't see many people do in the industry. Review the MEC status. How we review it specifically. Review the current dividend schedule, a conservative dividend schedule, and also the guaranteed values. What often happens is one reviews the MEC status, and based off the current status, the policy says, no, we will not run into a MEC. But then the individual, like that story I shared, actually runs into a MEC. So how do I actually stress test a policy as an agent? Or if I'm a consumer, how do I ask for that? Well, we do have that in our Agent Academy. I'm going to show you a quick example here, though. So here we go. Here's a policy with a 10/90 split, 35-year-old male, paying in $50,000 per year, $50K in. Here's his base premium, $5,000. Cash value, right off the bat, about $44,000. Breaking even between years 4 and 5. Okay, that's great. Here's what I want to touch on. Let's look at the bottom right-hand corner of the illustration. What do we have? MEC limit, about $55,000. So we always like to build in some extra space there. Okay, that's great. Now, keep this in mind. Cash value, $43,880, $253 year 5. Here's another policy, 10/90 split, same company, same $5,000 base premium, $43,882, $253 year 5. They're almost identical, a couple dollars off here, but pretty much the same thing. I'm going to go back to the first one. Here's what I want to touch on. Based off of the current illustration in the software, which is what most individuals look at, the policy did not MEC. So, based off the present dividend, no MEC, here we go. This policy is not a MEC based on the current supplemental values. This policy is a MEC in year 31 based on the midpoint supplemental values, meaning if the dividend rate comes down, we'll run into a modified endowment contract in this example, year 31. So is it likely? Not really, but it could happen. Based on the guarantees, no it doesn't. That's because the term rider blew up early. This was not a great example. However, let's go to the second example, which looked almost identical in terms of cash value. What do we got? Look at this. Not a MEC based on guarantees. Not a MEC based on midpoint supplemental values. Not a MEC based on the current supplemental values. My point here is, as an agent, this can be forecasted. You can look into it. It requires extra work and extra time. I will say that. With the experience I have really designing policies for corporations and just running illustrations all day long, looking at historical performance, it takes time. It takes our design team a lot of time to stress test that as well. But really the goal is there, how we operate as a company, design the policy for maximum cash value and make sure it doesn't MEC at any point down the road. That way the consumer is set up in the best possible situation. Now, if they adjust their payments up and down, that can have a bearing on the MEC test over time. Now, with that said, that's why we monitor it and make adjustments as time passes. So, can a policy MEC long-term? Yes, with any design. However, it is very easy to review it up front. What we want to look at is a lower dividend scale. The lower the dividend, the lower the death benefit. And the death benefit, if you're in a position where you say, hey, you keep talking about this death benefit, Steve. I thought this was about maximum cash value. I don't care about the life insurance. Well, remember that the death benefit has a direct relationship to the MEC limit. So to sum it up here, agents must look at the policy, specifically the MEC status in all scenarios. Current dividend, conservative dividend, guarantees. Take the extra steps. Put the work in. Don't just say it will MEC. Like that's, no disrespect here, but that's lazy to say, you can't go that direction with that lower commission product. Just do this way because it's always worked. It's safer. Like no, put the time in. Things can work out and then your client will be happy. On that point, it's the client's money that we're dealing with. Like if a client comes to me or to our company and says, hey, our goal is maximum cash value. There are other things we want to do with the money, but I want to optimize that first and foremost. We want to show them how to do that, but then more importantly, we want to make sure we don't run into trouble down the road in terms of a modified endowment contract occurring. So, can a MEC occur? Yes, but it won't if you do everything properly. So, around that objection of the MEC occurring, I do hope that this was helpful in terms of providing information of how to forecast if a MEC will occur and then how to prevent it. So we can absolutely have a maximum cash value life insurance policy without the worry of running into a MEC down the road. And if we did, it's very, very easy to fix. You can easily reverse it. We've had people run into MECs. I can count them on one hand, maybe a little bit more than one hand. But we have had people run into MECs. We have not had a person have a permanent MEC. We always catch it usually within a day or two actually because we're notified immediately and then reverse it with a simple note from the client to the insurance company or to us and we forward it and then they refund the difference, no longer a MEC. So I hope you enjoyed this one. If you have any questions, reach out anytime and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.